Audio Renaissance presents The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns, by John C. Bogle. Read for you by Tom Pinto. Dedication. Dedicated to Paul A. Samuelson, Professor of Economics at Massachusetts Institute of Technology, Nobel Laureate, Investment Sage. In 1948, his classic textbook introduced me to economics as a student at Princeton University. In 1974, his writings reignited my interest in market indexing as an investment strategy. In 1976, his Newsweek column applauded my creation of the world's first index mutual fund. In 1993, he wrote the foreword to my first book, and in 1999, he provided a powerful endorsement for my second. Now in his 92nd year, he remains my mentor, my inspiration, my shining light. Introduction. Don't allow a winner's game to become a loser's game. Let's start from the beginning. What is an index fund? It is simply a basket, portfolio, that holds many eggs, stocks, designed to mimic the overall performance of any financial market or market sector. Footnote: please keep in mind that an index may also be constructed around bonds in the bond market, or even road less traveled asset classes such as commodities or real estate. Today, if you wish, you could literally hold all of your wealth in a diversified set of index funds representing asset classes within the U.S. or the global economy. Classic index funds, by definition, basically represent the entire stock market basket, not just a few scattered eggs. Such index funds eliminate the risk of individual stocks, the risk of market sectors, and the risk of manager selection, with only stock market risk remaining, which is quite large enough, thank you. Index funds make up for their lack of excitement by their truly remarkable long-term productivity. This is much more than a book about index funds. It is a book that is determined to change the very way that you think about investing. For when you understand how our financial markets actually work, you will see that the index fund is indeed the only investment that guarantees that you will capture your fair share of the returns that American business earns. Thanks to the miracle of compounding, the accumulations of wealth over the years generated by those returns have been little short of fantastic. I'm speaking here about the classic index fund, one that is broadly diversified, holding all or almost all of its share of the $15 trillion capitalization of the U.S. stock market, operating with minimal expenses and without advisory fees, with tiny portfolio turnover, and with high tax efficiency. The index fund simply owns corporate America, buying an interest in each stock in the stock market in proportion to its market capitalization and then holding it forever. Please don't underestimate the power of compounding the generous returns earned by our businesses. Over the past century, our corporations have earned a return on their capital of 9.5% per year. Compounded at that rate over a decade, each $1 initially invested grows to $2.48. Over 2 decades, $6.14. Over 3 decades, $15.22. Over 4 decades, $37.72. And over 5 decades, $93.48. Footnote: these accumulations are measured in nominal dollars, with no adjustment for the long-term decline in their buying power, averaging about 3% a year since the 20th century began. If we use real inflation-adjusted dollars, the return drops from 9.5% to 6.5%. As a result, the accumulations of an initial investment of $1 would be $1.88, $3.52, $6.61, $12.42, and $23.31 for respective periods. The magic of compounding is little short of a miracle. Simply put, thanks to the growth, productivity, resourcefulness, and innovation of our corporations, capitalism creates wealth, a positive-sum game for its owners. Investing in equities is a winner's game. The returns earned by business are ultimately translated into the returns earned by the stock market itself. I have no way of knowing what share of these returns you have earned in the past, but academic studies suggest that if you are a typical investor in individual stocks, your returns have probably lagged the market by about 2.5 percentage points per year. Applying that figure to the annual return of 12% earned over the past 25 years by the Standard & Poor's 500 stock index, your annual return has been less than 10%. Result, your slice of the market pie, as it were, has been less than 80%. To make matters worse, as you will see in Chapter 5, if you are a typical investor in mutual funds, you've done even worse. If you don't believe that is what most investors experience, think for a moment, please, about the relentless rules of humble arithmetic. These iron rules define the game. As investors, all of us as a group earn the stock market's return. As a group, I hope you're sitting down for this astonishing revelation, we are average. Each extra return that one of us earns means that another of our fellow investors suffers a return shortfall of precisely the same dimension. Before the deduction of the cost of investing, beating the stock market is a zero-sum game. But the costs of playing the investment game both reduce the gains of the winners and increases the losses of the losers. So who wins? You know who wins. The man in the middle. Actually, the men and women in the middle. The brokers, the investment bankers, the money managers, the marketers, the lawyers, the accountants, the operations departments of our financial system, is the only sure winner in the game of investing. Our financial croupiers always win. In the casino, the house always wins. In horse racing, the track always wins. In the trifecta lottery, the state always wins. Investing is no different. After the deduction of the cost of investing, beating the stock market is a loser's game. Don't allow a winner's game to become a loser's game. Yes, after the costs of financial intermediation, all those brokerage commissions, portfolio transaction costs, and fund operating expenses, all those investment management fees, all those advertising dollars, and all those marketing schemes, and all those legal costs and custodial fees that we pay day after day and year after year, beating the market is inevitably a game for losers. No matter how many books are published and promoted purporting to show how easy it is to win, investors fall short. Indeed, when we add the cost of these self-help investment books into the equation, it becomes even more of a loser's game. The wonderful magic of compounding that is reflected in the long-term returns earned by American business, then, is translated into equally wonderful returns in the stock market. But those returns are overwhelmed by the powerful tyranny of compounding the costs of investing. For those who choose to play the game, the odds in favor of the successful achievement of superior returns are terrible. Simply playing the game consigns the average investor to a woeful shortfall to the returns generated by the stock market over the long term. Most investors in stocks, of course, think that they can avoid the pitfalls of investing by due diligence and knowledge, trading stocks with alacrity in order to stay one step ahead of the game. But the fact is that while the investors who trade the least have a fighting chance of capturing the market's return, those who trade the most are doomed to failure. For example, an academic study showed that the most active 1/5 of all stock traders turn their portfolios over at the rate of more than 21% per month. While they earned the market return of 17.9% per year during the period 1990 to 1996, they incurred trading costs of about 6.5%, leaving them with an annual return of but 11.4%, only 2/3 of the return in that strong market upsurge. Mutual fund investors, too, have inflated ideas of their own omniscience. They pick funds based on the recent performance superiority of fund managers, or even their long-term superiority, and hire advisors to help them do the same thing. But the advisors do it with even less success. See chapters 8, 9, and 10. Oblivious of the toll taken by costs, fund investors willingly pay heavy sales loads and incur excessive fund fees and expenses, and are unknowingly subjected to the substantial but hidden transaction costs incurred by funds as a result of their hyperactive portfolio turnover. Fund investors are confident that they can easily select superior fund managers. They are wrong. Contrarily, For those who invest and then drop out of the game and never pay a single unnecessary cost, the odds in favor of success are awesome. Why? Simply because they own businesses. And businesses as a group earn substantial returns on their capital and pay out dividends to their owners. Yes, many individual companies fail. Firms with flawed ideas and rigid strategies and weak managements ultimately fall victim to the creative destruction that is the hallmark of competitive capitalism, the formulation of Joseph E. Schumpeter in Capitalism, Socialism, and Democracy, 1942. But in the aggregate, businesses grow with the long-term growth of our vibrant economy. This book will tell you why you should stop contributing to the croupiers of the financial markets who rake in something like $400 billion each year from you and your fellow investors. It will also tell you how easy it is to do just that. Simply buy the entire stock market. Then, once you've bought your stocks, get out of the casino and stay out. Just hold the market portfolio forever. And that's what the index fund does. This investment philosophy is not only simple and elegant, the arithmetic on which it is based is irrefutable. But so long as investors accept the status quo of today's crazy quilt financial market system, so long as they enjoy the excitement, however costly, of buying and selling stocks, so long as they fail to realize that there is a better way, such a philosophy will seem counterintuitive. But I ask you to carefully consider the impassioned message of this little book. When you do, you too will want to join the revolution and invest in a new, more economical, more efficient, even more honest way, a more productive way, a way that will put your own interest first. It may seem far-fetched for me to hope that any single little book could ignite the spark of a revolution in investing. New ideas that fly in the face of the conventional wisdom of the day are always greeted with doubt, scorn, and even fear. Indeed, 230 years ago, the same challenge was faced by Thomas Paine, whose 1776 tract, Common Sense, helped spark the American Revolution. Here is what Tom Paine wrote. Perhaps the sentiments contained in the following pages are not yet sufficiently fashionable to procure them general favor. A long habit of not thinking a thing wrong gives it a superficial appearance of being right, and raises at first a formidable outcry in defense of custom. But the tumult soon subsides. Time makes more converts than reason. In the following pages, I offer nothing more than simple facts, plain arguments, and common sense, and have no other preliminaries to settle with the reader than that he will divest himself of prejudice and prepossession, and suffer his reason and his feelings to determine for themselves that he will put on, or rather that he will not put off, the true character of a man, and generously enlarge his views beyond the present day. As we now know, Thomas Paine's powerful and articulate arguments carried the day. The American Revolution led to our Constitution, which to this day defines the responsibility of our government, our citizens, and the fabric of our society. Inspired by his words, I titled my 1999 book, Common Sense on Mutual Funds, and asked investors to divest themselves of prejudice and to generously enlarge their views beyond the present day. In this new book, I reiterate that proposition. In Common Sense on Mutual Funds, I also applied to my idealistic self these words of the late journalist Michael Kelly. The driving dream of the idealist is that if he could only explain things to enough people, carefully enough, thoroughly enough, thoughtfully enough, why eventually everyone would see, and then everything would be fixed. This book is my attempt to explain the financial system to as many of you who will listen, carefully enough, thoroughly enough, and thoughtfully enough, so that you will see and it will be fixed, or at least that your own participation in it will be fixed. Some may suggest that, as the creator both of Vanguard in 1974 and of the world's first index mutual fund in 1975, I have a vested interest in persuading you of my views. Of course I do. But not because it enriches me to do so. It doesn't earn me a penny. Rather, I want to persuade you because the very elements that formed Vanguard's foundation all those years ago, all those values and structures and strategies, will enrich you. In the early years of indexing, my voice was a lonely one. But there were a few other thoughtful and respected believers whose ideas inspired me to carry on my mission. Today, many of the wisest and most successful investors endorse the index fund concept, and among academics, the acceptance is close to universal. But don't take my word for it. Listen to these independent experts with no axe to grind except for the truth about investing. You'll hear from some of them at the end of each chapter. Listen, for example, to this endorsement by Paul A. Samuelson, Nobel laureate and professor of economics at Massachusetts Institute of Technology, to whom this book is dedicated. Bogle's reasoned precepts can enable a few million of us savers to become in 20 years the envy of our suburban neighbors, while at the same time we have slept well in these eventful times. The financial system itself, alas, won't be fixed for a long time. But the glacial nature of that change doesn't prevent you from looking after your own self-interest. You don't need to participate in its expensive foolishness. If you choose to play the winner's game of owning businesses and refrain from playing the loser's game of trying to beat the market, you can begin the task simply by using your own common sense, understanding the system, and investing in accordance with the only principles that will eliminate substantially all of its excessive costs. Then at last, whatever returns our businesses may be generous enough to deliver in the years ahead, reflected as they will be in our stock and bond markets, you will be guaranteed to earn your fair share. John C. Bogle, Valley Forge, Pennsylvania, October 20th, 2006. Don't take my word for it. Charles T. Munger, Warren Buffett's partner at Berkshire Hathaway, puts it this way: the general systems of money management today require people to pretend to do something they can't do and like something they don't. It's a funny business because on a net basis, the whole investment management business together gives no value added to all buyers combined. That's the way it has to work. Mutual funds charge 2% per year, and then brokers switch people between funds, costing another 3 to 4 percentage points. The poor guy in the general public is getting a terrible product from the professionals. I think it's disgusting. It's much better to be part of a system that delivers value to the people who buy the product. William Bernstein, investment advisor and neurologist, and author of The 4 Pillars of Investing, says, "It's bad enough that you have to take market risk. Only a fool takes on the additional risk of doing yet more damage by failing to diversify properly with his or her nest egg. Avoid the problem. Buy a well-run index fund and own the whole market." Here's how The Economist of London puts it. The truth is that, for the most part, fund managers have offered extremely poor value for money. Their records of outperformance are almost always followed by stretches of underperformance. Over long periods of time, hardly any fund managers have beaten the market averages. They encourage investors, rather than spread their risks wisely or seek the best match for their future liabilities, to put their money into the most modish assets going, often just when they become overvalued. And all the while they charge the clients big fees for the privilege of losing their money. One specific lesson is the merits of indexed investing. You will almost never find a fund manager who can repeatedly beat the market. It is better to invest in an indexed fund that promises a market return, but with significantly lower fees. Chapter 1. A Parable with a Moral. The Gottschalk Family. Even before you think about index funds, in their most basic form, mutual funds that simply buy all of the stocks in the U.S. stock market and hold them forever, you must understand how the stock market actually works. Perhaps this homely parable, my version of a story told by Warren Buffett, chairman of Berkshire Hathaway Incorporated, in the firm's 2005 annual report, will help clarify the foolishness and counterproductivity of our vast and complex financial market system. Once upon a time, a wealthy family named the Gottschalks, grown over the generations to include thousands of brothers, sisters, aunts, uncles, and cousins, owned 100% of every stock in America. Each year, they reaped the rewards of investing, all of the earnings growth that those thousands of corporations generated, and all of the dividends that they distributed. To complicate matters just a bit, the Gottrocks family, of course, also purchased the new public offerings of securities that were issued each year. Each family member grew wealthier at the same pace, and all was harmonious. Their investment had compounded over the decades, creating enormous wealth, for the Gottrocks family was playing a winner's game. But after a while, a few fast-talking helpers persuade some of the Gottrocks cousins that they can earn a larger share than the other relatives. These helpers convince the cousins to sell some of their shares in the companies to other family members and to buy some shares of others from them in return. The helpers handle the transactions and, as brokers, receive commissions for their services. The ownership is thus rearranged among the family members. To their surprise, however, the family wealth begins to grow at a slower pace. Why? Because the family share of that generous pie that American industry bakes each year, all those dividends paid, all those earnings reinvested in the business, 100% at the outset, starts to decline, simply because some of the return is now consumed by the helpers. To make matters worse, while the family had always paid taxes on their dividends, some of the members are now also paying taxes on the capital gains they realize from their stock swapping back and forth, further diminishing the family's total wealth. The smart cousins quickly realize that their plan has actually diminished the rate of growth in the family's wealth. They recognize that their foray into stock picking has been a failure, and conclude that they need professional assistance, the better to pick the right stocks for themselves. So they hire stock picking experts, more helpers, to gain an advantage. These money managers charge a fee for their services. So when the family appraises its wealth a year later, it finds that its share of the pie has diminished even further. To make matters still worse, the new managers feel the compulsion to earn their keep by trading the family's stocks at feverish levels of activity, not only increasing the brokerage commissions paid to the first set of helpers, but running up the tax bill as well. Now the family's earlier 100% share of the dividend and earnings pie is even further diminished. Well, we failed to pick good stocks for ourselves, and when that didn't work, we also failed to pick managers who could do so, the smart cousins say. What shall we do? Undeterred by their two previous failures, they decide to hire still more helpers. They retain the best investment consultants and financial planners they can find to advise them on how to select the right managers, who will then surely pick the right stocks. The consultants, of course, tell them that they can do exactly that. Just pay us a fee for our services, the new helpers assure the cousins, and all will be well. Alas, the family share of the pie tumbles once again. Alarmed at last, the family sits down together and takes stock of the events that have transpired since some of them began to try to outsmart the others. How is it, they ask, that our original 100% share of the pie, made up each year of all of those dividends and earnings, has dwindled to just 60%? Their wisest member, a sage old uncle, softly responds, "All that money you've paid to those helpers and all those unnecessary extra taxes you're paying come directly out of our family's total earnings and dividends. Go back to square one and do so immediately. Get rid of all your brokers. Get rid of all your money managers. Get rid of all your consultants. Then our family will again reap 100% of however large a pie that corporate America bakes for us year after year." They did exactly that, returning to their original passive but productive strategy, holding all of the stocks of corporate America and standing pat, exactly what an index fund does. And the Gottrocks family lived happily ever after. Adding a fourth law to Sir Isaac Newton's 3 laws of motion, the inimitable Warren Buffett puts the moral of the story this way: for investors as a whole, returns decrease as motion increases. Accurate as that cryptic statement is, I'd add that the parable reflects the profound conflict of interest between those who work in the investment business and those who invest in stocks and bonds. The way to wealth for those in the business is to persuade their clients, don't just stand there, do something. But the way to wealth for their clients in the aggregate is to follow the opposite maxim. Don't do something, just stand there. For that is the only way to avoid playing the loser's game of trying to beat the market. When any business is conducted in a way that directly defies the interests of its clients in the aggregate, it is only a matter of time until change comes. The moral of the story, then, is that successful investing is about owning businesses and reaping the huge rewards provided by the dividends and earnings growth of our nation's corporations. The higher the level of their investment activity, the greater the cost of financial intermediation and taxes, the less the net return that the business owners as a group receive. The lower the cost that investors as a group incur, the higher rewards that they reap. So to realize the winning returns generated by American business over the long term, the intelligent investor will minimize to the bare bones the costs of financial intermediation. That's what indexing is all about, and that's what this book is all about. Don't take my word for it. Listen to Jack R. Meyer, former president of Harvard Management Company, the remarkably successful wizard who tripled the Harvard Endowment Fund from $8 billion to $27 billion. Here's what he had to say in a Business Week interview. The investment business is a giant scam. Most people think they can find managers who can outperform, but most people are wrong. I will say that 85 to 90% of managers fail to match their benchmarks. Because managers have fees and incur transaction costs, you know that in the aggregate, they are deleting value. When asked if private investors can draw any lessons from what Harvard does, Mr. Meyer responded, "Yes. First, get diversified. Come up with a portfolio that covers a lot of asset classes. Second, you want to keep your fees low. That means avoiding the most hyped but expensive funds in favor of low-cost index funds. And finally, invest for the long term. Investors should simply have index funds to keep their fees low and their taxes down. No doubt about it." In terms that are a bit more academic, Princeton professor Burton G. Malkiel, author of A Random Walk Down Wall Street, expresses these views. Index funds have regularly produced rates of return exceeding those of active managers by close to 2 percentage points. There are two fundamental reasons for this excess performance: management fees and trading costs. Public index funds are typically run at a fee of less than 0.2%. Actively managed public mutual funds charge annual management and market expenses that on average are 150 basis points, 1.5 percentage points per year. Moreover, index funds trade only when necessary, whereas active funds typically have a turnover rate close to 100%, and often even more, with trading costs of at least another 0.5 to 1% of performance a year, and probably a lot more. Active management as a whole cannot achieve gross returns exceeding the market as a whole, and therefore they must, on average, underperform the indexes by the amount of these expense and transaction cost disadvantages. Experience conclusively shows that index fund buyers are likely to obtain results exceeding those of the typical fund manager, whose large advisory fees and substantial portfolio turnover tend to reduce investment yields. Many people will find the guarantee of playing the stock market game at par every round a very attractive one. The index fund is a sensible, serviceable method for obtaining the market's rate of return with absolutely no effort and minimal expense. Chapter 2. Business Reality Trumps Market Expectations. Here begins the first lesson. That wonderful opening parable brings home the central reality of investing. The most that owners in the aggregate can earn between now and Judgment Day is what their business in the aggregate earns, in the words of Warren Buffett. Illustrating the point with Berkshire Hathaway, the publicly owned investment company he has run for 40 years, Buffett says, "When the stock temporarily overperforms or underperforms the business, a limited number of shareholders, either sellers or buyers, receive outsized benefits at the expense of those they trade with. But over time, the aggregate gains made by Berkshire shareholders must of necessity match the business gains of the company. How often investors lose sight of that eternal principle. Yet the record is crystal clear. History, if only we would take the trouble to look at it, reveals the remarkable, if essential, linkage between the cumulative long-term returns earned by American business, the annual dividend yield, plus the annual rate of earnings growth, and the cumulative returns earned by the U.S. stock market itself.